January 2023, China's central bank reports another month of gold purchases, then February, then March. By the end of the year, global central banks have bought over 1,000 metric tons of gold, the highest annual total in modern history. But here's the part that should disturb you. While governments were buying, retail investors were selling. Individual citizens across the West were liquidating gold holdings at near-record rates, convinced that inflation was over, that stocks were safer, that gold was a relic. The divergence wasn't subtle, it was a canyon, and it tells you everything you need to know about what's really happening. Gold is not a store of value for ordinary people. It never was. Gold is a political tool, a weapon governments use to preserve sovereignty when fiat systems fracture. And the pattern is always the same. When citizens panic and sell, central banks accumulate. When the public believes gold is useless, governments stockpile it quietly. And when the reset comes, the institutions that hold gold dictate the terms. By the end of this video, you will understand why gold flows from citizens to states during every major transition, what mechanism drives that transfer, and what the current accumulation cycle tells you about the phase we're entering now. I've spent years analyzing central bank balance sheets, sovereign reserve data, and the history of monetary resets. What I'm about to show you isn't mysticism or gold bug ideology. It's documented policy, repeated across centuries, visible in IMF reports, BIS filings, and Treasury disclosures. This is educational content, not financial advice. But if you want to understand what governments know that the public doesn't, this is the pattern. Here's the structure. First, we're going to destroy the myth that gold is for individual wealth protection and show you what it actually is: a reserve asset for governments. Second, we'll walk through 1933, the year the U.S. confiscated private gold and used it to recapitalize the monetary system. Third, we'll examine 1971, when Nixon closed the gold window and governments began dumping gold onto the public at peak prices. Fourth, we'll reveal what's happening right now, the largest central bank gold accumulation in 50 years, happening silently while retail sells. Fifth, we'll expose the psychological mechanism, how fear is weaponized to transfer assets from individuals to institutions. And finally, we'll give you the timeline, the indicators, and the trap you need to avoid. Let's start with the foundational lie that gold is a hedge for ordinary people. Gold is sold to the public as financial insurance, a store of value, a hedge against inflation and currency collapse. You've heard the pitch 1,000 times. Buy gold, protect your wealth, preserve your purchasing power. But that story is a distraction. Gold doesn't protect individuals during crises. It protects governments. The difference is not semantic. It's structural. When monetary systems break, gold doesn't save citizens from inflation or confiscation. It gives states the leverage to restructure the system on their terms. Gold is not a refuge, it's a reset mechanism. And every time the system fractures, the pattern repeats. Citizens hold paper, governments hold metal, and the reset transfers wealth from the former to the latter. Think of gold as the ultimate political collateral. When confidence in fiat currency erodes, when debt spirals out of control, when international trust collapses, gold becomes the asset that allows governments to negotiate, restructure, and recapitalize. It's not about individual survival. It's about sovereign bargaining power. This is why central banks hold thousands of tons of gold, even though they publicly claim it's a barbarous relic. This is why the IMF, the BIS, and every major economy maintain gold reserves despite decades of saying it's irrelevant. They know what you're not supposed to realize. Gold is the fallback asset when everything else fails. And the institutions that control it control the terms of the next system. Here's the mechanism in its simplest form. Think of gold as the anchor in a storm. When fiat systems are stable, gold sits dormant, unnecessary, dismissed, even mocked. But when the storm hits, when currencies devalue and debt becomes unsustainable, that anchor becomes the only fixed point. Governments that hold gold can stabilize their position. Governments without it are swept away. This is the oldest trick in monetary history. Convince the public that gold is outdated, accumulate it quietly, then use it to reset the system when the time comes. The public holds paper promises, the state holds physical leverage, and when the reset happens, paper burns while metal endures. Now let's go back to the first modern demonstration of this mechanism, 1933. April 5th, 1933. Franklin Roosevelt signs Executive Order 6102. Overnight, private gold ownership becomes illegal in the United States. Citizens are ordered to turn in their gold coins, bars, and certificates to the Federal Reserve in exchange for paper dollars at a fixed rate of $20.67 per ounce. Refusal is a crime punishable by 10 years in prison and a $10,000 fine. The official justification is economic emergency, stabilizing the banking system, preventing hoarding, restoring confidence. But the real purpose is something else entirely: recapitalizing the government. Here's what actually happened. By 1933, the U.S. was trapped in deflation. Debt burdens were crushing. Banks were failing. The gold standard limited the government's ability to expand the money supply because every dollar had to be backed by gold in the Treasury. So Roosevelt broke the link, but not by abandoning gold. Instead, he confiscated it from citizens, revalued it upward to $35 per ounce, and used that revaluation to expand the monetary base. The government didn't lose gold reserves, it gained them, and it did so by legally seizing private wealth and converting it into sovereign leverage. This was not an anomaly, it was policy. The gold wasn't returned, it wasn't compensated fairly. It was transferred from individuals to the state and then used as the foundation for the next monetary regime, Bretton Woods. In 1944, when the Allied powers met to design the post-war financial system, the U.S. held over 20,000 tons of gold, more than any nation in history. That gold gave America the power to make the dollar the world's reserve currency, backed by gold at a fixed rate. Every other currency was pegged to the dollar was pegged to gold, and the U.S. controlled the anchor. Here's the punchline. The gold that gave America that power didn't come from mining or trade. It came from confiscation. The citizens who turned in their gold in 1933 were told it was temporary, necessary, patriotic. But their gold became the collateral for American monetary dominance for the next 3 decades. The pattern was set. When the system needs to reset, gold flows from citizens to governments, and those who hold it write the rules. But the story doesn't end in 1933. It repeats in 1971, only this time the direction reverses. August 15, 1971. Richard Nixon closes the gold window. Foreign governments can no longer exchange dollars for gold at the fixed rate. The Bretton Woods system collapses. The dollar becomes a pure fiat currency, backed by nothing except trust and military power. And gold, which had been the anchor of the global monetary system for decades, is suddenly declared obsolete. Central banks begin selling. Governments announce that gold is a barbarous relic, an outdated constraint, unnecessary in the modern era of managed currencies, and the public, convinced that gold is finished, begins buying, at precisely the moment institutions are unloading. Here's the mechanism. In the decade after 1971, gold prices skyrocketed. By 1980, gold hit over $800 per ounce, a 40-fold increase from the Bretton Woods fixed rate. Retail investors, convinced they had discovered the ultimate hedge, poured money into gold. Coin dealers exploded. Gold fever gripped the public. And at the peak, central banks were selling. The U.S. Treasury auctioned gold. The IMF sold reserves. European central banks liquidated holdings. The institutions that had accumulated gold during the previous crisis were now distributing it to the public at inflated prices. This is the inverse cycle. Governments accumulate when gold is cheap and dismissed. They distribute when it's expensive and hyped. And then, after the peak, gold entered a 2-decade bear market. From 1980 to 2001, gold lost more than 60% of its value. Retail investors who bought at the top were crushed. The narrative shifted. Gold was dead, a relic, a boomer obsession. The future was tech stocks, real estate, financial innovation. Central banks continued selling through the 1990s, dumping hundreds of tons per year under the Washington Agreement on gold. The message was clear. Gold was finished. But here's what the public didn't see. Even while selling, central banks never went to zero. They reduced holdings, but they maintained a floor. They never fully exited. They were managing inventory, not abandoning the asset. And in the background, a new accumulation phase was beginning. Fast forward to 2008. The financial crisis hits. Quantitative easing begins. Debt explodes. And quietly, central banks stop selling gold. By 2010, they become net buyers. And in the last 5 years, that buying has accelerated to levels not seen in half a century. Between 2020 and 2024, central banks purchased over 2,500 tons of gold. China, Russia, India, Turkey, Poland, nations across the spectrum have been accumulating aggressively. The purchases are not speculative, they are strategic. These governments are not buying gold because they think the price will go up. They are buying it because they believe the dollar-dominated system is entering a fragile phase, and gold is the only asset that allows them to preserve sovereignty outside that system. The buying is not hidden, it's reported in IMF data, disclosed in central bank statements, tracked in BIS filings, but it's ignored by the public narrative, dismissed as irrelevant, downplayed by financial media. And while central banks were buying, retail investors in the West were selling. Gold ETFs saw outflows for 3 consecutive years. Individual investors liquidated positions, convinced that the inflation scare was over, that central banks had everything under control, that stocks and bonds were safer bets. The divergence is stunning. The largest institutions in the world are accumulating gold at the fastest pace in modern history, while ordinary citizens are exiting. This is not a coincidence. This is the pattern repeating in real time. Here's what the data shows. According to the World Gold Council, central banks added over 1,000 tons in 2022 alone, the highest annual total on record. The buying continued through 2023 and into 2024. At the same time, Western gold ETFs saw net outflows of over 200 tons. The metal didn't disappear, it changed hands. It flowed from retail investors to sovereign institutions. And every time this pattern emerges, it signals the same thing, a transition phase. The institutions are preparing for a reset, and they are doing it by accumulating the one asset that cannot be printed, defaulted on, or devalued by decree. Now let's talk about the psychology that makes this transfer possible. The mechanism is elegant. During calm periods, gold is portrayed as outdated, useless, a poor investment. Financial media emphasizes its lack of yield, its volatility, its irrelevance in modern portfolios. Retail investors are conditioned to view gold as a fringe asset, something for conspiracy theorists and doomsday preppers. This conditioning is not accidental. It ensures that when prices are low and accumulation is cheap, the public stays away. Then, when crises hit, the narrative flips. Gold is suddenly the only safe haven. Prices spike. Retail investors panic buy at elevated levels. And institutions that accumulated quietly during the dismissal phase begin distributing at peak prices. This is the gold trap. It works because human psychology is predictable. Fear and greed operate on a lag. By the time the public recognizes the value of an asset, the smart money has already positioned. By the time retail investors buy, institutions are preparing to sell. The cycle is visible in every major monetary transition, 1933, 1971, 2008, and now. The public is always late, the state is always early, and the transfer happens in plain sight, hidden only by narrative control. Here's the evidence in the current cycle. Between 2018 and 2021, gold prices rose from around $1,200 to over $2,000 per ounce. Retail interest surged. Gold ETFs saw inflows. Coin sales spiked. The public narrative was that gold was finally reclaiming its role as a safe haven, but central banks were buying the entire time, not because of the price, but because of the structural shift they saw coming. Then, in 2022, when the Fed began raising rates and the dollar strengthened, gold pulled back. Retail investors sold, convinced the opportunity had passed, and central banks kept buying. The price didn't matter. The accumulation continued because the strategy was never about short-term returns, it was about positioning for the reset. Now let's address the objections. You've heard them before. This time is different. Technology has changed everything. Gold is irrelevant in a digital age. Central banks are just diversifying reserves. Nothing systemic is happening. Let's dismantle these quickly. First objection, this time is different because of technology. Response, every era believes it has transcended the old rules. The 1920s had electrification and radio, the 1990s had the internet, the 2010s had smartphones and AI, yet the monetary cycles remain identical. Technology changes productivity, it does not change the mathematics of debt, the physics of currency debasement, or the political logic of resets. Gold's role as sovereign collateral is independent of technological advancement. Second objection, central banks can print forever, so gold is unnecessary. Response, printing works until it doesn't. The limit is not mechanical. Central banks can always create more currency. The limit is confidence. When creditors, allies, and citizens stop believing in the value of that currency, printing accelerates the collapse instead of preventing it. Gold is the hedge against that confidence loss. It's the asset that holds value when fiat systems break. That's why central banks hold it even while claiming it's irrelevant. Third objection, reserve currencies don't fail. Response, tell that to Rome, Spain, the Netherlands, Britain, or any empire that issued the dominant currency of its era. Every reserve currency in history has eventually lost that status. The dollar's dominance is not permanent. It's a function of military power, economic scale, and institutional trust. All three are eroding, and when the transition happens, the nations holding gold will have leverage. The nations holding only dollars will not. The pattern is consistent. The mechanism is clear. Now let's talk about what to watch. Here's your clock. 3 indicators that signal the phase transition is accelerating. First, official gold reserves of non-Western central banks. If China, Russia, and other nations continue accumulating at current rates, they will collectively hold enough gold to back a significant portion of their trade flows outside the dollar system. Watch for the threshold where their combined reserves exceed 15,000 tons. That's the point where an alternative settlement mechanism becomes structurally viable. Second, gold's price behavior relative to real interest rates. Historically, gold falls when real rates rise because it competes with yield-bearing assets. But in the last 2 years, gold has held firm even as rates increased. This divergence suggests that demand is no longer driven by financial returns, but by strategic positioning. If gold breaks above $2,500 per ounce and holds while real rates remain positive, it signals that sovereign accumulation has decoupled from market pricing, a sign that the reset phase is near. Third, public rhetoric from central banks about gold's role. If institutions like the IMF, BIS, or major central banks begin openly discussing gold as a component of a reformed monetary system, it means the transition is being prepared. Watch for speeches, policy papers, or international agreements that reintroduce gold as a reference point for currency stability or trade settlement. The narrative shift will precede the structural shift. Timeline: near term, within the next 12 to 18 months, expect continued divergence between central bank buying and retail selling. This is the accumulation phase. Midterm, within 3 to 5 years, watch for the first signs of a multilateral agreement or discussion about monetary reform that includes gold. This is the preparation phase. Long-term, within a decade, the probability of a formalized reset, where gold plays a role in stabilizing a new system, rises significantly. The direction is firm. The timing is uncertain. But the mechanism is already in motion. So what do? I can't tell you what to buy or sell, but I can share principles. First, understand that gold is not an investment for appreciation. It's a hedge against systemic dislocation. If you hold it for the scenario where fiat systems break, not for price gains. Second, recognize that small individual holdings do not replicate sovereign leverage. Governments accumulate thousands of tons. Your stack does not give you bargaining power in a reset. It may preserve some value, but it won't give you influence. Third, avoid the trap of panic buying at peaks. If you believe gold has a role in your risk management, accumulate steadily during periods of dismissal, not during periods of hype. Fourth, do not confuse physical gold with paper proxies. ETFs, futures, and allocated accounts are not the same as metal in your possession. In a true crisis, counterparty risk matters. Fifth, diversify your resilience. Gold is one component, not a complete strategy. Skills, relationships, liquidity, and geographic optionality all matter. And sixth, do not assume that holding gold makes you sovereign. It doesn't. Sovereignty requires scale, institutions, and political power. Gold is leverage for governments, not escape for individuals. Here's what not to do. Do not buy gold because a guru told you to. Do not invest money you cannot afford to lose. And do not believe that gold alone will save you from systemic collapse. It won't. The reset will happen at the institutional level. Your holdings, however large they feel to you, are rounding errors in that equation. The goal is not to win the reset. The goal is to avoid being sacrificed during it. Let me close with this. Gold is not a store of value for ordinary people. It is a political tool, a weapon that governments use to preserve sovereignty when fiat systems fracture. The pattern has repeated for centuries. During stability, gold is dismissed, mocked, and sold to the public at inflated prices. During transitions, gold is accumulated by states and used to recapitalize systems, negotiate resets, and dictate terms. The cycle we are in now is unmistakable. Central banks are buying at record levels while the public sells. This is not neutral. This is the transfer phase. And when the reset comes, the institutions that hold gold will write the rules. The individuals who chase paper will discover too late that their wealth was denominated in promises that couldn't be kept. Gold is never freedom, it's leverage, and leverage belongs to those with scale. We are in late-stage accumulation. The public is exiting, the sovereigns are positioning, and the trap has already closed for those who don't see it. If this analysis helped you, hit subscribe and drop a comment. Do you think gold's role in the next system will be overt or hidden? Let's see where the consensus lands. This is educational content, not financial advice. Do your own research and consider professional guidance. But whatever you believe about gold, understand this. It's not a hedge for you, it's a reset button for them, and they're getting ready to press it.